Welcome back to Yahoo Finance. I'm Shauna Smith. We have stocks rallying this afternoon with less than 90 minutes left in the trading day. Oil closing just a few minutes ago, falling 8% today, settling at $26.08 a barrel. In the broader markets, though, we are seeing a huge move to the upside with consumer discretionary, utilities, and materials as the top performing sectors. Here to talk more about today's action, I want to bring in John Grace, founder and president of Investors Advantage Corp. And John, thanks for joining us this afternoon. It's been quite a day, really, when you take a look at the rally, the Dow up over 1,200 points. What do you think is priced in at this point?
Well, Shauna, I think the market is looking forward for the next 30 days, which looks kind of promising. We love these green shoots. I would say we have to keep an eye on oil because often the markets do follow oil. And if prices continue to decline or don't respond, then I think the market eventually will respond to that kind of activity. So it's going to be interesting to see how this all turns out. You know, what in the same 24 hours, we hear that things are going to get very bad. And the next thing we're seeing that we've got, good news on the horizon. So let's jump up and down and do backflips. Well, we'll see how this plays out. But I'm saying don't trust this.
Well, John, what about earnings? Because I know you're saying don't trust this. It's so hard to try to predict what we could see out of corporations over the first quarter. Most strategists are now expecting a modest decline in earnings. A FactSet was out with numbers. They were saying that on average, and strategists expect EPS to decline just around 4.5% in 2020. Goldman, by far the biggest bear of the big firms, they see EPS falling 33% to 110. What are you expecting at this point?
We've got to be agile. It is futile to forecast as far as I'm concerned, okay? If you look at any sports, whether you participate or you're a spectator, you have to play both sides of the fence, both sides of the net. People have these expectations and then they fall short. What I'm saying is what you can do, what investors can do, which they did not know they could do for the last 20 years, but they can, and that's find strategies that will limit their losses. So if it is the case that we're going into, what was the Great Depression one, it took 3 years to see unemployment at 24%. We now see forecasts that in less than 3 months, we might be at 25 to 30%. Will that last longer than 30 days? We will see. But if it does, I think that's going to impact earnings. I don't think that's being seen right now. And as I say, for investors, I think it's all about limiting the losses, much more than it is buy and hold and hope, sit and take it, buy the dips. When it gets ugly very viciously. And that's when people get disenchanted. And that's when they become remorseful. And clearly, they have regret for gosh knows how long. But I don't think we want to have regret. We want to limit the losses.
Well, John, when you are looking to buy in this environment, I know you're saying you have to be cautious, you have to think about limiting the downside here, but what are you looking for when determining what to buy? How do you decide what looks attractive in this type of environment?
What we like to do, Shauna, is compartmentalize. In other words, I'm not, whether it's cash, stocks, bonds, currencies, or commodities, we want all of them to be actively managed. For example, in November, investors started in some of their investment vehicles 100% equities, beginning of November. By the end of November, they were 100% U.S. Treasuries. It all happened behind the scenes. They didn't have to call us. We didn't have to call them. The strategies did the work. And clearly, when we're looking at the evidence as of Friday, we're up about 23% overall. When we're looking at being whole and having captured those gains, that's the kind of work we like to see.
John, real quick, I need to ask you, I was reading through the notes that you sent over before the show, and it's interesting. I was talking to Brian Levitt at the top of the show today. We were comparing a V-shaped recovery to a U-shaped recovery, what we'll likely see. You actually say that you expect to see an L-shaped recovery. What do you mean by that?
Well, I'm saying it could happen. I'm not saying expect it. I'm saying we all want these green shoots. We all want to just jump up and down. It's a V-shaped recovery. Suppose it's not. Let's just go back in history. We can see two examples. More recently, we see Japan. We can agree that 88, 89, Japan was going to eat our lunch. Notice that their stock market and their real estate market peaked around 1990 to 1991. Here's the trick question. Which one has come back to even? Is it the Japan stock market or the Japan real estate market? And the answer to the trick question is neither of the above. It's now 30 years. Neither have gotten back to their highs. The Nikkei 225 peaked at 39,000, dropped to 10, then went down to 7. I think today it was around 18.5. It's clearly not back to even. Here in the U.S., we saw the market dropped right after the Great Depression, 80%. That took $1 million to approximately 108,000. You did not get back to even for 25 years, assuming you didn't sell anything and assuming you still held the same Dow 10 stocks. Who didn't sell anything? And remember, if you're an adult, early 1900s, I'm sorry, life expectancy was mid-50s. So I'm saying to you, that's my biggest concern. People take positions, the market moves against them, and then they have regret for their time here on Earth.
All right, we'll leave it there. John Grace, Investors Advantage Corp. Thanks so much for joining me today.
My pleasure, Shauna.
Well, turning